So, as the Federal Reserve continues to cut interest rates, what happens to our credit cards, student loans, and personal loans? There are two words I want you to remember when it comes to debt: variable and fixed. We saw 11 rate hikes until they finally paused in July 2023. It was difficult to borrow money on either variable interest or fixed interest, right? So, as the rate cuts continue, credit card interest rates will also come down, right? But not as fast as you think they will. So credit card interests, if you don't notice, they are variable interest rates. So credit cards have always been expensive to borrow because banks carry more risk to issuers than secure loans. So if you fail to pay back your credit card, it just goes to a collection agency and the bank will probably sue you for failing to make payments. But if you fail to make car payments, then they can just take away your vehicle, right? And you're still gonna owe money for it. And so let's say you have $10,000 on your credit card balance, okay? And this is got a 25% interest rate, and you're gonna spend around $2,500 in interest per year, right? So if you carry over the balance, if your interest rate say drops to 24%, then it's just going to be dropped to $2,400, or saving about $100 in interest for the year. And credit cards can become extremely predatory if you're not being careful with your spending. And as soon as you realize that you're going to start carrying a balance on your credit card, stop using your credit card immediately. You need to reassess your financial situation by budgeting your expenses. You're spending more than you make at this point. Just because the Fed cut interest rates, it doesn't mean you should now carry a balance on your credit card. And I always recommend that you pay off your credit cards as soon as possible. As the rate cuts continue, you might see more 0% interest credit cards becoming available to you. You might qualify for a balance transfer credit card to give you a year or more without interest accruing on the balance. Remember that you're making a transfer to pay down your debt faster, not to extend the payment plans, right? Now, let's talk about the next one. Your vehicle loans. Your car loans were very expensive for either new vehicles or used vehicles. The interest rates on the car loans follow the path of the federal funds rates, but it's going to take some time to see changes after the rate cuts. How much your interest rates are going to be will depend on your credit scores, credit history, and loan term, and the age of the vehicle. What you want to pay attention to is how much you're paying for your vehicle. Can you truly avoid the car loan that you're trying to purchase? And I always recommend against taking out a car loan, because you're taking out a loan for something that depreciates every year. But I understand that not everyone can afford to buy a car with cash right now. What you don't want to do is overpay for something that depreciates annually. So treat this vehicle that is going to take you from point A to point B. So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. So if you're looking to buy a vehicle here, and let's say for $10,000 for a used vehicle, you need to save 20% of that vehicle price, or $2,000. So you just need to finance $8,000, right? So let me go ahead and write that down. The down payment, $2,000. And I'm gonna take out the sales tax. So if you need to finance, let's say $8,000, if you get a 10% interest right now, which is really high for, let's say, 2 years, let's calculate that. All right, so the car loans, let's say you do $10,000, okay? So you make a down payment for $2,000. And if you do a 24-month loan term, then that's gonna get you, let's say, 10% interest for 2 years. And that's gonna be about $370 per month. And if you do it for, say, 3 years, that should be about $260 per month. And let me know if I'm wrong in the comment section. Is it worth paying $100 a month more on the car payment so that you can pay it off in 2 years instead of 3 years? Absolutely. You do not want a high car payment for 6, 7, or even 8 years. It is one of the worst loans out there that will destroy your wealth. Now, This is coming from someone who used to have 2 vehicle loans, all right, back in 2013. Let's say you're already in the mess of a car loan with 6 years and your car is upside down in value. You have 2 choices. You can sell the car and take out a personal loan to pay for the deficit and get a cheaper vehicle, or pay off your current car loan as soon as possible. You can also take this time to improve your credit scores and credit history before purchasing your next vehicle. Going from 10% interest to 7% will just save you about $300 in total interest payments for 2 years. So it's not really going to be worth it to refinance your vehicle unless you have like a 25% interest rate on your car loan and you want to bring it down to 7%, then that would be a completely different story, right? And I have seen that. Some vehicle loans are very, very predatory. And once you have your car paid off, you can put that same amount of car payment towards an index fund that pays you, let's say, 7%, right? And let's say you just invest, do the initial value, and then $400 a month, so $4,800 a year, and do for 5 years. And you can go to firesightcheck.com/resources for the compound interest calculator that I'm showing you right now. You're gonna have over $27,000 in total value. Can you wait 5 years to pay for a vehicle that you wanted with cash? How about 10 years when it grows to 66,000? And I buy a car every 15 to 20 years because it is one of the worst depreciating assets and a necessity for transportation. It's not something that I like to go out and just buy a brand new vehicle every single time. And a lot of Americans do it. Don't do it. Stop doing it. Okay. Now, and if you have a business loan, personal loan, or student loan at a higher rate, now may be the time for you to refinance, but only if you have the plan to pay it off within the next 24 to 36 months. You have to aggressively pay down your consumer debt to increase your savings rate. How can you save and invest 15 or 25% of your income when your total debt repayments are more than 15% of your net income? Also remember that a Fed interest rate cut will only impact private student loans and not federal student loans. Lowering your interest rates will depend on your credit scores. You should find out if refinancing is a good option for you at the time you're watching this video. And if you have a variable rate private student loan, you should consider refinancing it to a fixed rate loan.